All right, so every single month there's this one economic report that drops, and boom, it can send shockwaves through pretty much everything, from the stock market all the way to the price of crypto. Yep, I'm talking about the CPI. Understanding it is absolutely crucial. So in this explainer, we're going to break it all down, what it is, how it works, and why it has so much power over your portfolio. First things first, let's talk about the reaction. Because, the second this report gets released, markets don't just listen, they move, and they move fast. So that leads to the big question, right? Why? Why do these three little letters, CPI, cause so much, chaos? How can one single data point from a government agency instantly shake up the value of your investments? Well, the answer is actually pretty simple. This report is our clearest signal on inflation. And inflation, that's the first domino in a huge chain reaction that can affect the value of pretty much every asset on the planet. Okay, so let's get right to the heart of it. What exactly is the Consumer Price Index? At its core, the CPI is really just a measure of the cost of living. The easiest way to think about it is like a giant official shopping cart for the entire country. The government basically fills this cart with the exact same stuff every month, and then they track how much the total bill changes over time. And that change? That's inflation. And if you take a look here, you can see what's actually in that basket. It's not some abstract thing. No, it's the stuff we all spend money on every day. Housing, transportation, food, medical care. This is basically a snapshot of an average person's budget. And whoa, just look at that number. Housing alone, that makes up over 44% of the entire index. That is huge. It means the cost of your rent or your mortgage has a massive, massive influence on the country's entire inflation reading. It's the single biggest piece of the puzzle, by far. Okay, so now we know what's in the basket, but we need to talk about the two different ways this data is presented. And this is a really crucial distinction: headline versus core inflation. So here's the deal. Headline CPI is the total number, right? It's everything in the basket. But core CPI, that's the one that strips out food and gas prices. Now, why would they do that? Well, because those prices can swing wildly from month to month due to stuff like bad weather or global politics, which don't really tell you about the long-term inflation trend. And this chart, man, it really shows you the difference. See that spiky blue line? That's the headline number. It's all over the place. But the orange line, that's core inflation. It's so much smoother. It gives policymakers like the Federal Reserve a much clearer signal about those persistent, kind of sticky price pressures. That's the number they are really watching. So how does this government statistic actually end up affecting your investment account? Let's connect the dots and trace that chain reaction we were talking about. It pretty much works like this. If the CPI report comes out hot, which just means inflation is high, the Federal Reserve starts to get concerned. To cool the economy down, they raise interest rates. That makes it more expensive for everyone, you, me, businesses, to borrow money. This tightening of financial conditions, it usually makes investors a lot less willing to take risks, so they might start selling assets like stocks and crypto. This flowchart here leads that relationship out perfectly. You can see the two paths central banks are trying to navigate. On one side, they hike rates to fight inflation, but that risks slowing down the economy. On the other side, they can cut rates to boost growth, but that might just fuel more inflation. It's this constant, delicate balancing act. And this is especially true for crypto. I mean, why does Bitcoin react so strongly to a CPI report? Well, it's because assets like Bitcoin absolutely thrive on liquidity, which is just the amount of cash flowing through the system, and a high appetite for risk. When interest rates are low and money is easy, there's a flood of cash looking for a home in speculative assets. But when the Fed tightens the taps to fight inflation, that flow can dry up almost instantly. But here it is, the final and probably the most important piece of this whole puzzle. It's not just about whether the inflation number is high or low. The real story is something else entirely. This right here is the secret. You see, markets are always trying to guess the future. Economists spend all their time creating forecasts for what the CPI number will be. The market then prices that expectation in before the report even comes out. The real fireworks, the big market moves, they happen when the actual number is different from what everyone was expecting. I'm going to say that one more time because it is the most important takeaway here. The surprise matters more than the number itself. A high inflation number that everyone saw coming might just cause a little ripple.
But an inflation number that's even slightly lower than expected, that can trigger a massive rally because it completely changes the market's bet on what the Fed will do next.
And this is how you can start to read the market's reaction like a pro. Don't just look at the big headline number. You got to dig into the details, like shelter inflation, which we now know is a huge part of it, and services inflation, which can be really sticky. That's where you'll find the real story of where things are actually headed. So now you know. The CPI isn't just some boring number. It's a powerful signal that directs the flow of money all around the world. You know about the basket, the difference between headline and core, and most importantly, the power of the surprise. So when the next report drops, you'll be ready to look beyond the headlines. The only question is, what will you be looking for?